Last week, we began the two-part Raising Capital series. This week, we take a look at the second part of the tale. Here's the how, where, and when of funding your startup.
Nikhil Nath knew little about the hospitality industry before launching No Cross Solutions in 2003. And today, the company serves almost 100 hotels, including the big names like Oberoi and Marriott, with its revenue mark touching 5 crore rupees. After developing its first product, Triton, a guest management software, No Cross got its first round of angel investment worth 1 crore rupees from Indian Angel Network in 2006. And thanks to all that moolah, No Cross has scaled up significantly.
At the time, we were sort of a five-man company, and we're today 40 people. At the time, our revenues were, I think, in the year before I invested probably maybe a few tens of lakhs. We're north of $1 million today. So definitely the capital went to work and got its return.
Angel financing usually comes at an early or prototype stage. Retired businessmen and successful entrepreneurs who have tasted success in the past step into angel funding to help and guide other businesses flourish. But besides capital, what are the other benefits of angel funding?
What angel investors do is two things. A, they spend a lot of time and effort apart from their money in helping entrepreneurs succeed. Advice, guidance, connection to their networks, sharing their experiences, everything. But they also expect a high return because this is very high risk.
High risk because angel investors fund your idea when you're not yet to prove your business model. But if your business has crossed the first hurdle and you are growth stage, then a venture capitalist will be willing to step in. But remember that your business plan should fulfill what a venture capitalist is looking for.
We are looking for a very strong management team which has a proven track record, is complete, and has some domain expertise in the area that they're building the business in. Second piece would be the size of the market. How large the market is would determine how big a business you build. The third piece would be, is there some differentiation in terms of technology that you are using, or are you the first ones off the block? How you separate from the rest of the pack. And fourth would be the potential returns that we can get from the business.
Both angel investors and venture capitalists provide strategic guidance and domain knowledge to budding entrepreneurs. Where strength of mentoring is a similarity, how are the two different for your business? While angel investors come at an early stage, venture capitalists help you scale up your business. Angel investors put in their personal money and write checks for small amount. A VC, on the other hand, invests in institutional money that typically varies from 10 crore rupees to 50 crore rupees for a period of 5 to 7 years. And while angel investors are open to invest in all sectors, technology-oriented business are a sweet spot for venture capitalists, thanks to its scalability potential. But are there any deal terms for such investors?
We like to be minority investors, which means that we would like to have ownership between 20 to 35%, so that founders feel that they are in the saddle and are driving the company. So that is our preference. We generally like to be present on the boards.
With entrepreneurship mushrooming up on a big scale in India, there are a plethora of angel investors and venture capitalists that are adding to the startup funding ecosystem. While they help push the growth curve, remember that both angel investors and venture capitalists get attracted to a scalable business that exhibit an effective exit strategy.
Now that you know there's absolutely nothing stopping you from hitting that next stop on your journey to to raising capital.